Okay, well, welcome everybody. Welcome to Captain's Table, and thank you all very much for joining us today. My name is Tony Hall. As most of you know, I run Navigator Consulting. We are a recruitment industry growth specialist, helping to grow recruitment companies. And as part of what we do, we have our regular Captains and Consultants Table knowledge forums once a month, and really appreciate you all being here today. I especially recognise Peter Langford, who has been to almost every Captain's Table since we restarted it 3 years ago. Thank you very much, Peter, for being here. But thank you, everyone. I know there's a lot of webinars happening, but we really try and pack a lot of good quality information and organise speakers that can really help you in the current market and help you to be growing your recruitment business. So I also need to make special recognition to our supporters, and those of you that attend regularly know that we've had great support from JobAdder, from A Positive, from DigitPro, and from our speakers today, William Buck. All of these companies have a very unique perspective on the industry, and even if you haven't yet used their services, I do encourage you to contact them, because there is so much knowledge there that they're gathering from many different companies in the marketplace, and they learn so much, and they can pass that knowledge on to you. So thank you to everyone supporting us. And William Buck is every year they present at this time, because it's a critical time in the business calendar. As you know, it's pre-June 30, so there's some very important things to do pre-June 30, but this time in their presentation, it's not just about pre-June 30, it's how to handle this very difficult market, and also what's happening out there in government support land. So we've got Cameron Martin leading off the presentation, with Diana, his counterpart in Melbourne. So Cameron, Sydney, Diana, Melbourne, and we've got Angela from the Brisbane office. So we've got the whole east coast of Australia covered off in our presentation today. So William Buck team, thank you very much. Really very much looking forward to your presentation today, and over to you, Cameron.
Thanks, Tony. Appreciate the introduction. It's great to be here to talk to you about what's happening in the financial land. And as mentioned, this time of year, we think is really important to revisit your finances and sort of, make some actions that you need to before the end of the financial year, but also set yourselves up really well for next year. So this slide's just a little bit about myself and Diana. So we'll both be presenting, and as Tony mentioned, I'm from the Sydney office, a director in Sydney, and Diana's from Melbourne. Just a little bit about us quickly. So yeah, we're a national firm, William Buck, of accountants and advisors. We offer an integrated business and financial services sort of service offering, including audit, business advisory, corporate advisory, tax, wealth, the whole suite. We've got a very big, diverse group of clients, mainly SME businesses. So, the sort of people that we're dealing with and talking to every day would be similar to you guys in a similar situation, running service businesses and just trying to keep up with all the tax changes and make sure that their business is financially set up correctly. In terms of our catchphrase for our business is changing lives, and we really do truly believe that we do help our clients change their lives and in their financial sense. And we also believe at the moment that the health crisis is potentially largely under control, and the government is now saying that the shift needs to be to the economic impacts and all this sort of stuff. So we really now see this as the time for our industry to step up and sort of help our SME clients who could potentially ultimately bear the brunt of any sort of economic downturn. A lot of large companies that are listed companies or substantial companies have got strong balance sheets. They've got the ability to potentially raise capital, and so we believe that potentially the SME market could be where there could be some pain to be felt. And so now is the time to consult with your advisors. It's never been a more important time, because by consulting and working through some of your scenarios and some of your issues could be the difference between you just getting by and surviving this next sort of 6 or so months, and the difference between potentially thriving in this new environment that we're about to go into. So we also believe that, no one wants change, especially, what we're going through with COVID-19. No one asked for it, but at the end of the day, it's here to stay, and we've got to make the most of it. So whenever there's change, there's always opportunities. If you look back to the GFC, there was actually a lot of new businesses created out of the GFC. People had more time to think about stuff, and they also focused a lot more closely on their business. They couldn't just turn up to work and write new business. They actually had to go and do a lot more thinking about stuff. So, you're seeing the share market, for example, at the moment, the number of new online trading accounts being opened is, 10 times what it was a few months ago. To me, that's people saying there's change in the share market. Here's an opportunity for me to maybe make some money. I think you can all do that in your recruitment businesses and say, here's some change. Let's actually just take advantage of it and, do something about it rather than just sitting on the sidelines and doing something, doing nothing. So I'll quickly hand over to Di, who will go through the topics that we're going to talk about today.
Chris, took me off mute. So a classic mistake I've made in the past. So just quickly, just to go through, we'll be looking at 4 main areas. Cam's going to start with looking at entitlements and eligibility for government assistance. So a lot of you are familiar with those, so we'll go into those just briefly. I'll also then look at cash flow and strategies for business continuity. Cam will then go over to preparing for the next phase and changes to the new normal. And then I will then go to, and we'll end off with year-end tax planning. So over to you, Cam.
Thanks, Di. So the first area, and I will go through this quite quickly, but I think it is really, really important to actually summarise all these government incentives and entitlements are on offer. Unfortunately, the way it's worked over the last couple of months is that they've all been drip-fed out. So there was an announcement one day, and then a week later, another announcement. And so quite a lot of clients we're talking to, small businesses, are saying that they're under control. They've watched the news, they've heard the Prime Minister speak, they understand what's out there, and they understand that they're either eligible or not eligible. But we're still on a sort of daily or weekly basis talking to people that aren't aware of some of these incentives. For example, the extension for JobKeeper registration, if you want to start claiming back from the 30th of March, finishes this Friday. So we're still getting people ringing up, or we're talking to them and we're saying, well, have you applied for JobKeeper? And they're saying, no, I'm not eligible. And within a few minutes of discussing things, there's potentially an opportunity where they were wrong and they actually are eligible. And so they're now applying. So that can make a big difference. I think it's worthwhile spending a few minutes now just going through some of these things. So the first one I wanted to go through was just the cash flow boost. And this is one of the first announcements the government made. And this is where all businesses that have an aggregated turnover of less than $50 million a year can get a benefit anywhere between $20,000 and $100,000. It's available to all businesses that employ staff, regardless of whether you've been affected by COVID or not. So that's a common misperception, is that people are saying, well, no, that my business is not affected by COVID, so I'm not eligible. With this particular payment, everyone that employs people is eligible. And so it's a tax-free payment. You don't have to include it as taxable income, so it's quite a nice little bonus to help you. There's a first payment and a second payment. So if you've lodged your March BASs already, you may have already seen this initial payment come through. So this first payment is anywhere between $10,000 and $50,000. And then you'll get a second payment that will be spread across June to September, depending on whether you report your pay-as-you-go withholding on a monthly or quarterly basis. So that's the cash flow boost. And that really largely should just be something that you receive automatically. We are seeing a lot more ATO activity in relation to newer businesses, and they are checking some of the claims, and they are spending a bit of time making sure that people are getting it. The other misconception is that you only get it once per business. If you've got 4 entities in your group that are employing staff and potentially meet the level of withholding, you could potentially get up to $400,000 out of this cash flow boost. So it's a nice little incentive for all businesses to help us through this time. The next area I just wanted to briefly talk about was the commercial rental arrangement. So if you're eligible for the JobKeeper subsidy scheme, then you fall into the code of conduct in relation to landlord and rental arrangements. So it doesn't mean that just because you're not eligible for JobKeeper, it doesn't mean you can't go to your landlord and request some sort of rent reduction or deferral or some sort of incentive there. But if you're in the JobKeeper scheme, the landlord does have to negotiate with you on good faith, and there are some rules in particular in relation to the code that landlords have to give you for the period that the JobKeeper system runs. Different states have different interpretations of it, so even though there was a national announcement, each state has implemented it slightly different. One little trick is that in New South Wales, whatever you agree on, you have to do that for the whole 6-month period, where in Victoria, if things get worse, for example, in July, you have the opportunity to go back to your landlord and say, actually, my turnover is now worse than it was before. Can we now have another look at this? So how it actually works is that landlords must offer their tenants a proportional reduction in rent. So to give you a quick example, if your rent is $10,000 per month and your turnover is down by 50%, your landlord has to give you a reduction in your rent of $5,000, being 50% of that $10,000 a month. Half that $5,000 needs to be what's called a waiver. So that's where you don't actually have to pay it back in the future. And the other half is a deferral. So we're seeing landlords then say that other half, maybe you can pay that off over the next 4 years if your lease has got 4 years to run, or whatever that happens to be. So we are seeing that a lot of private landlords are negotiating quite fairly and quickly and coming back to the party with something that's reasonable. We're seeing the bigger landlords like the real estate investment trusts who are taking a lot longer. They're asking for a lot more information, and we're finding that businesses are getting a bit stuck with all the information that's required. So my tip there would be to potentially just try and push back, and if they ask for bank statements and all sorts of information, just say, I understand under the code that you don't, there's no requirement to give that information, and just keep pushing ahead and just saying, under the JobKeeper, our turnover is down 40%, so we'd like a 40% reduction in our rent, and sort of go on that basis. There's also some other things where landlords, if you happen to also be the landlord, so if you happen to own your business premises, there's opportunities where you can go to the state governments and get reductions in land taxes and things like that. If your self-managed super fund owns your premises, then I'd probably recommend talking to your advisor if you're going to start adjusting any of those terms, so you could get into some issues in terms of some of those rules and how they apply. So that's just a quick snapshot on the commercial rental arrangements. If you haven't gone to your landlord and asked for a reduction, I'd recommend you do. The worst they can say is no. If you're in the JobKeeper system, then they actually do have to negotiate and talk to you. I'm also seeing some private landlords allow businesses to basically assess their turnover on a monthly basis and then apply those rental reductions based on whatever that sort of reduction in turnover happens to be. So if your reduction is 30% in the first month and then it moves to 40%, say in June, the landlord's giving you the ability to give you more of a reduction. And hopefully going forward in July, August, September, if the turnover then goes back up again, potentially those reductions could also then reduce. So it's just up to what you can negotiate, but the code of conduct is basically a fallback position. It just gives everyone an opportunity to make sure that there's something there that you can negotiate on. The biggest area in relation to these incentives that we've seen, businesses, in particular recruiters, get access to is the JobKeeper system. So this is where the government will pay eligible businesses $1,500 per fortnight per employee, based on any employee that was eligible or was employed at the 1st of March. And it applies for, assuming your turnover is less than $1 billion a year, you just need to have suffered a decline in turnover of 30%. And that's based on GST turnover, not based on what you might report in your P&L. So you've got to be careful that you go back and have a look at your BASs and see how you're reporting your GST. The test period can be any month or quarter, as long as you've got a comparison period. So a lot of people we're seeing are reporting against, say, the month of April or the quarter April to June. And as long as you've got a comparison period 12 months ago that you can compare that turnover reduction, you can go with that particular period. There is also some of these alternative tests that they brought out later in the piece that if you don't meet one of the basic tests in terms of how to measure your turnover, that you can apply. But we are cautioning people that those rules are pretty complicated and that we're seeing potentially some ATO audit activity in relation to people applying those alternate tests. The other misconception that I'm seeing quite regularly still is people thinking that just because they suffered a 30% turnover in April, and then in May their turnover might have then bounced back and they're only reduction of 20%, that they then have to opt out of the scheme. The way it works is if you meet the condition up front and you get into the scheme, then you're in the scheme for the whole 6 months, which is from the 30th of March all the way through to the 27th of September. But also too, if you don't meet the eligibility up front, you might, for example, in the month of June, start to suffer a reduction in turnover of 30%. And on that basis, you can opt in then. So we're seeing quite a few recruiters, and particularly ones that are heavily perm-based, where their April numbers actually weren't that badly affected because they placed people in March that started in April, and so their turnover, was based on, when they were raising invoices for those people that were starting. And then I've seen that in the month of May, some of those businesses heavily perm-based have really started to see a massive decline in their turnover. In relation to eligible employees, so what we're seeing there is the issue that a lot of recruiters that have got labour hire or contracting businesses, as to whether your employees are actually permanent or whether they're casuals. And partly it's a legal question, and I'd probably recommend if you've got concerns or you're not sure about your eligible employees to consult a lawyer. But a lot of recruiters we're seeing are deciding to just leave their contractors alone and treat them as casuals. And the reason they're doing that is that they're saying that, if you do try and now treat your contractors as permanent employees, there's potentially a lot of fair work issues that you bring into play. And if you are treating them like casuals, you're not paying them annual leave and you're not paying them sick leave, then it's difficult to then justify that they're now suddenly, permanent employees. The other thing there to keep in mind is that we're seeing some, host employers then coming back to the recruiters and saying, if you've got JobKeeper for this particular person that's on our site, we'd like you to pass that saving on to us. If you're invoicing us on a cost plus a margin, we'd expect to see that reduction that you're getting through JobKeeper come back to us. So there's a few issues that some people are dealing with, but if you're not sure about the legalities of whether you've got a casual or a permanent employee, I'd recommend get some legal advice on that. We are going to see some ATO activity in relation to this area, so I would recommend that people make sure they've got their signed nomination forms on file from their employees, and really spend some time. And even if you may have an internal bookkeeper or accountant that's looking after it for you, take some time to review the claims and just talk to them about what's happening, because they may not be aware of things that are going on in the business. So we're already seeing issues where people are, new hires or people leaving, and whether people are overclaiming or underclaiming for those people. So if you've got a large payroll, it's not a straightforward process. There's quite a lot of complexities in there. In particular, we saw quite a few of our clients initially say they were going to register for JobKeeper and do the administration themselves. And then once they've gone through the process part way, they've come back to us and said, we really need some help. Can you, have a look at it for us? So the keys are, you need to have made sure you pay, people at least $1,500. So if someone's getting paid more than $1,500 a fortnight, you don't need to do anything about it. But if they're getting paid less than that because they're stood down or they're casuals, for example, then you need to make sure you top them up to that $1,500 before you make the claim. Another one I've had questions on is that I've now got someone that was a casual who on the 1st of March didn't have 12-month service, but since the 1st of March, they now have met the 12-month service. Our understanding is that it was a test as of the 1st of March. So you can't now have someone that was at 11 months at the 1st of March. They're now at 12 months. They're now at 12 months, so they're eligible. Unfortunately, if they weren't at that 12-month mark at the 1st of March, they can't get access to the system. The other thing with the JobKeeper payments are that they are assessable income, so you do need to include them in your P&L and your tax return as income. and they're effectively a government subsidy to allow you to pay your wages, which then becomes a deduction for you. The other question I get asked a lot is, why are the ATO asking for my forecast for next month and my actual this month turnover? They've told us that they're doing that so that they can get some economic data to see whether people that are in the JobKeeper, those businesses, are turning around and then quickly rebounding, or how they're going. And we believe that's probably the case, but we also think that they're going to use that data to assess what people they audit. So if you've estimated that you're going to be down 35% turnover, then it's likely that if your turnover is only down by 5 or 10% on your actual data, that it's more likely that you're going to get looked at. And that doesn't mean that you've done anything wrong and that you shouldn't have claimed JobKeeper. But what it means is that you're more likely that your forecasts are going to be under more sort of scrutiny. So that's the JobKeeper payments. In terms of other assistance, so just a quick summary here of some of the other things that you might be eligible for. So a lot of these announcements were made, as I said at the start, at different times, and they were drip fed to us. So just in summary, if you've got apprentices, or you've got, you're working with clients that you're placing people that are apprentices, there's potentially this 50% wage subsidy. The banks are going to give government guaranteed loans. So if you're not sure about where you're going and your cash flow, it might be a good idea to contact your bank and see if you can get one of these government guaranteed loans. There was also some announcements in relation to instant write-off of $150,000. So what I'm seeing in recruitment businesses is that people are saying, well, I've got more people working from home. I'd like to buy some more technology, some more laptops or some tech stuff to allow them to work from home, maybe a nice webcam, some stuff like that. So there's the ability that you can write that stuff off in this particular financial year rather than depreciating it over a couple of years. Most of the state governments have announced payroll tax reliefs and deferrals, so you should check and see what's available there. There's also a state government grant. So most of the states have given a $10,000 grant to eligible businesses, and most of those businesses are the ones that are not eligible for the payroll tax relief. So as an example, that Victoria, their $10,000 state government grant, the applications actually sort of close on the 1st of June. So if you're not sure whether you're eligible, I'd suggest check. And if you are, put your application in this week so that you never know, you might be able to get that. So some of the businesses that immediately got it were the travel and tourism and hospitality, but they're also looking at other businesses that might be eligible.
And just extending on that as well, we have had the State Revenue Office actually reach out to clients to say, initially when you applied for the grant, you were rejected, but we've now extended it. And if you are eligible for JobKeeper, you will get the grant. And it's come through for a couple of clients, and clients have reapplied and the funds have come through very quickly. And I'm talking within 10 to 12 days. So it's definitely something to revisit. Of course, there are tests around that grant, but yeah, definitely something to revisit.
Yeah, perfect. Thanks, Di. And then quickly too, in terms of ATO, so there is also the ability, the ATO being very flexible. So if you owe the ATO money and you've lodged your March BAS and you can't afford to pay it, just contact them. There is payment deferrals in relation to that. And they've also said that if you've paid quarterly tax instalments throughout the year, they potentially without penalty will allow you to claim back those instalments in this latest BAS, and also vary your tax instalments, regardless of whether you may or may not be paying tax. So hopefully that's a quick summary of some of those things, and hopefully it might have tweaked your interest in some of those things that you may have overlooked. And my suggestion is just go back and have a look at everything. If you haven't applied for it or you didn't think you're eligible, just go back again this week and make sure that that's still the case, because you hate to miss out on one of these things. And the next area that we're going to go through is understanding cash flow and strategies for business continuity. Over to you, Di.
Hi. I think cash flow has probably been one of the hottest topics for most businesses, and not only for businesses, but extending out to people's personal positions. So it's definitely something that we recommend is revisited and looked at on a very regular basis. Most of you would have already probably torn your profit and loss statement apart and looked at all your costs to identify anything that you feel is not necessary. What we're finding is that every time someone picks up their profit and loss again, there's always something else they find that they can kind of cross off. So it's definitely something that we recommend that you do on a regular basis. You would now probably have a very clear position as to what income's coming through under any of the stimulus packages. So when you are preparing your cash flow and you are doing forecasting, it's really important that you incorporate those numbers. The tax office has been quite lenient and helpful in terms of offering deferrals with quarterly instalments and other payment amounts owing. So these deferrals, it's very, very important that these are incorporated in the forecasts, and they may even require you to extend those forecasts for at least up to 12 months to get the full picture. What we're finding is we see some really nice forecasts for a 6-month period, and then when they realise that these large lump sums have to be paid, the question of where that money is going to come from if things continue, income continues to decrease, comes in. So it's really important. Having up-to-date accounts, again, as we move towards the 30th of June is really important, but also to understand what your tax liabilities are in respect to this financial year, and again, to be incorporated in your forecast. It's very important. I'll touch on tax planning later, but things like, Division 7A, amounts like that will impact your income and your tax as well, so they need to be incorporated, very important. What we're finding and what we're encouraging is that most business owners should have a team, and a panel, whatever they may call it, and they will sit together and they meet regularly and they help the business navigate through this time. We're encouraging it. It's something that we're seeing is making a difference. It's also sharing the responsibility as big decisions are being made on a very, very regular basis, and that those decisions around the business direction, around people, etc. So we think it's very important that if you do not have that team, that you reach out and you bring together a team to help navigate you through this time. And scenario planning is something that we believe that if you haven't started doing that this particular team can help you sit down and come up with some best case and worst case scenarios for you and your business, and to do some forecasting projections around that. And with the intention, of course, to continue the business and hopefully in most circumstances come out the other end and continue, probably not as usual, as normal, but continue. It's really important that you do have a think about, I think, the worst case scenario and what that would mean for you from a business perspective and a personal perspective. Next slide, Cam. Strategies for business continuity. So just touching on what I've already spoken about. So it's really important that you have regular reporting around what's happening, not just financial, but also non-financial reporting, and that you are in touch with a lot of the key people that impact and affect your business. Just a second. Now, the regular reporting should have some clear, I guess, guidelines for you as a business owner as to what are your tolerances. And things like, for example, we have a lot of business owners who are injecting personal funds to keep businesses going, and are sitting down and making decisions that this is the dollar amount that I want to put in and I'm not going to go over. So I think it's very important that you are clear on that and not continually dipping in and injecting funds in the business. I think it's very, very important. When you meet on this, when you meet with your team on the regular basis, it's really important. Again, I'm using the word important as well too many times, but to be talking about just general business issues as well. And what we're finding is probably one of the biggest hot topics at the moment is not only keeping the business afloat, but continuing to bring business in this current environment. Most of us are working from home. Most of us are in front of computers. Most of us are jumping from one meeting, maybe on Skype and Zoom, on and off. But how to best manage or your BD activity to continue to stay in contact with your advocates, with your referrers, and to be able to explore opportunities to bring in new business. So what we're finding and what we're also encouraging is that business owners are thinking about that and speaking to the experts around adapting to the current environment. Now, Cam, I think I've finished up there, so over to you.
Okay, so the next area that we're going to go through, so Di's helped you with sort of like this next period in terms of making sure that you're under control, that your cash flow is good, that you've done your scenario planning so things don't sort of come out of the woodwork and you're not prepared on how to deal with it. But I think there's a lot of talk around the traps about the fact that things aren't going to go back to normal and that we're not going to just turn around in September, October and we'll be back to what it was in January, February. It's definitely going to be different. And so, how can you prepare for that difference and what's it going to look like? So what we're saying to people is that you can just sit on the sidelines and just wait for the economic activity to come back up again. And potentially that might work for you. But our feeling and our talking to a lot of business owners is that that's probably not going to happen. And that if you just sit there and wait for things to improve, they're not going to. You've actually got to go out there and do something. Businesses are still hiring, not at the same level as they were before. So what that means is maybe as an industry, in particular perm placements are going to be down by X%, but it doesn't mean they're down to zero. So it just means that you've got to be ahead of the game and you've got to work harder to get that business. And to do that, you may need to change your business model. Like if you're in a technology or a health industry, maybe as your specialization, you may not actually be seeing any changes at all. You might even be seeing some improvements in things that are going. But if you're not, then you may need to pivot into a different category. And so an example of that I'll give you is in the accounting and finance area at the moment, there's a lot of businesses that have put a freeze on hiring, but there are some subcategories like the insolvency area where we're expecting that once JobKeeper finishes at the end of September, and also when the moratorium on liquidations and some of those repeals that the government have allowed, is that there will be a big uptake. And so we're expecting that insolvency work to increase, and those insolvency practitioners are sort of gearing up and getting extra staff on board. So if you're someone that's targeting that particular subcategory, you're going to do a lot better than someone that's just trying to target the whole category. And target industries that are booming if you've got experience. If you've got no experience in the industry, yeah, you're going to struggle, but you tend to find that most people have had some experience in more than one industry, even if they specialize. And if that's the case, go and target those industries and spend more time on them. If you potentially may not have the right people. And so if you don't have the right people, you may need to make some tough decisions. In terms of, an example of, for example, hospitality, you may be thinking, well, there's nothing I can do there. At the moment, hospitality is dead. There's nothing much happening. But all these hospitality businesses are going to have to reopen and reopen differently. They're going to potentially need a lot more cleaners, and they're going to need a lot more cleaning work done. So potentially target the cleaners, target those, talk to your clients and find out what they need, and potentially you can pivot into some of those areas and offer them the help to do that. I'm also seeing people try new locations or new markets that they weren't able to before. So for example, Tony was mentioning at the start of this that he's enjoying not traveling all the time. And there was a feeling there before COVID that if you didn't travel and meet someone face to face, you really couldn't do business. We're now on the same level playing field. Everyone has to use Zoom. No one can go and meet people face to face. So if you were considering targeting, maybe Western Australia, for example, and you didn't think that you had the resources or the capabilities to try that market, now's an opportunity to do it, because everyone that's targeting that market is also going to be doing video calls. No one's going to be there face to face. So now might be the opportunity with video conferencing, that there's no barriers. and break into that period and that market and see how you go. It might not cost you a lot. If it doesn't work out, then you haven't lost a lot. If it does work out, then maybe it's a new opportunity for you that once things, open back up again, you can then potentially get some people on the ground in those locations. If you haven't been doing much contracting in the past and you've just been very perm focused, now might be the time to change that mix. We've seen that the perm market is way down with new hires, but the contracting and temp market in some industries in particular is holding up, and in some cases actually, increasing. So you may want to consider, do you have that right mix? And is there something you can do to change that going forward? The other thing that we're seeing is, and sort of dovetailing on what Diana was talking about with your cash flow and your budgeting, that's so important, because if you don't know where you stand, you can't make some decisions on where you're going to go forward. So if your business, for example, is breaking even or it's losing money and you're getting substantial government incentives included as part of that, or you're getting JobKeeper and all you're doing is breaking even or still losing money, what happens when JobKeeper goes away? And as I said at the start of this section, you can't just sit on the sidelines and wait and hope that it'll all go back to normal, because I think it's probably not going to be that case. So you do need to look at it, and you do need to maybe make some hard decisions. So if you've got some staff that are not sort of high performers, and you don't think they're going to be resilient enough to and dynamic enough to work in a tough market, you might need to make some tough decisions to move them on now, rather than just waiting until we get to October. So they're tough decisions, but I think you need to look at your numbers and do some budgets and work out where you're going, because there's no point just carrying someone and then getting to October and then having to make those tough decisions, or potentially not making the tough decisions and ending up in a situation where you go into Christmas where you've lost lots of money and you don't know, where you're going. I think whatever you decide to do, you've got to do something different, but you've also got to make sure that you maintain a nice cash buffer to allow you to do that.
And Cam, just extending on what you said as well, I think just the whole topic of solvency, it's really important to remember that, if you are trading insolvent, that you could be personally liable as a director. So there is temporary relief for financially distressed businesses for 6 months, and I think that expires in September. But it's really important to stay on top of it for that particular reason. And you may be familiar with the term safe harbour. We're currently working with some clients to help them get some protection under safe harbour. So where their solvency is questionable, the safe harbour rules have some guidelines and some guidance on how you can make sure that you can protect, or make sure that if something does go wrong, that your personal assets are protected. So without going into any more detail, but yeah, so definitely something to keep in mind.
Yeah, no, it's a really good point. Don't just stick your head in the sand. If you're losing money and you're bleeding cash, don't think that there's nothing you can do. Potentially there are rules that allow you to restructure your business and to come out the other side. So yeah, I just recommend talk to your advisor if you're having troubles, and get help early. Don't just dwell on it and hope that you'll get yourself out of a hole if you're in that hole. In relation to working from home, so I won't go into a lot of detail on that, because there's lots of people that are talking about working from home, and I think next month's Captain's Table we're doing a lot of that stuff. But in terms of the premises, I'm seeing a lot of people consider doing what I call musical chairs. So if you've got 30 seats in your business and going forward you're only going to need 20, then potentially there's a business that's currently got 20 seats and they think they only need 10 seats. And potentially by talking to some real estate advisors, they could potentially help businesses, play musical chairs and move premises. You might think at the moment no one would want to take extra space and no one's going to want to move, but they will. If you've got 30 seats and you only need 15, you're going to want to move. And if you've got 50 seats and you only need 30, then someone's going to do that. So don't just think that that's not an option. Spend some time, looking at that. And working on the theme of don't just sit on the sidelines. If you've got some time now, spend it on doing some of the things you always wanted to do in your business. So, make sure your website's up to date. Use some of that government, assistance money to maybe update your website. Get your branding up to date. Make sure your systems are right. I'm seeing quite a few people, and surprisingly, inquiries for accounting and finance related stuff where they potentially wanted to outsource their accounting work, but they just never had the time to do it. And now that they've had a bit of a reduction in turnover, the business owners have a bit of time and headspace to actually start thinking and looking at that sort of stuff. So again, use the opportunity and use the time wisely to get there. And the last point I was just going to make here was just preparing your business for a second wave. So, hopefully there isn't going to be a second wave, but I don't think you can just sit on the sidelines and expect that, we'll just deal with that when it comes. I think we all agree, when this hit us in March, we're all hoping it wasn't going to hit us as bad as it has, and in terms of sending everyone home. But I think you need to really, do that planning and work out, well, what would I do, and how would my business survive from a supplier, customer, staff, and look at all of those different areas before you go any further. So that's all that I had to talk about in relation to that new normal and getting your business up and running. But just in summary, you've got to do something. I think anyone that just thinks that this economic activity is just going to return to normal, I think is probably going to be mistaken. There is business out there and there are people that are hiring. You've just got to make sure that your business is sort of in that top tier percentage where you're driving that business and you're giving your customers what they want. If you do that, I think you've got a chance of doing particularly well. So the next area we're going to talk about was tax planning. Diana.
Over to tax planning, the most exciting part of the year. Usually looking back to see how much profit we've made, or again, this time it's very different to previous years. But again, there's lots of, under the stimulus, there's additional things that we need to think about. You may be familiar with the instant write-off as well. So you can get an instant asset write-off for anything under $150,000. So that needs to be purchased and installed prior to 30 June. Please note that there is a luxury car limit. It's about $57,000 as well, so it's limited to that amount. Also note that any capital works to property, etc., are excluded too. So they fall under another division. So it's something to keep in mind.
So my only comment there, Diana, is I think some people might think, well, I'm struggling with my business. I'm just trying to get everything up and running, and I'm trying to, I'm hearing what you're saying about the new normal, and I've got to make changes to my business. But surely tax planning is the least of my worries. Where what I've seen actually in a lot of recruitment businesses, they were doing really well up to the end of March or April, and they've actually made quite a bit of profit. And the last thing they want to now do is just ignore tax planning and end up with a big tax bill in 6 months' time that potentially by then they've used that cash on other things. So I think this area, it's always important, but I think this year it's actually more important than ever to really focus some attention on this stuff.
Absolutely. Absolutely. And some people might laugh and say, well, business is doing well, how am I going to afford to buy something? But look, I'm finding a lot of businesses who are really spending some money setting up their people from home as well. So things like computers and all of that. So it's definitely something that people are thinking about. So that's under the stimulus measures. Now, anything that's over $150,000, you do get 50% depreciation in the first year. So just remember that. So if it's not under 150 and it's over, you get 50%. So just keep that in mind. You also probably, again, at this stage, you'll need to revisit any of the cash flow boosts that have come through and just making sure that you're comfortable with what's accessible, what's not accessible. With JobKeeper, as Cameron said, accessible. The cash boosts are just an adjustment to payments, so they're not income. And the most important thing is that they're properly reflected in the accounts. So your accounts, this is the time where a lot of people are jumping back on to get their accounts in order. They're running around to try and keep things moving within the business, but now definitely as we come closer to the 1st of June is the time to jump back on and get those accounts right. Division 7A, again, any loans, money that's been taken out personally that are under loan agreements, it's very important to get an understanding of what repayments need to be made and how that impacts your final tax bill. Any new loans too, it's time to strategize around that as to when it will be repaid or how it will be repaid. Very important. Tax rates as well. This year's tax rate for base rate entities, which is probably most of you, 27.5%. And next year it will drop to 26%. So something to keep in mind when you're doing some planning around paying out dividends and from your company if you're structured and set up in a company. Trust minutes as well. So whether your business is in a trust or whether you have a trust as a related entity that works in line with your business, etc., or your personal trust, it's important to be reminded that these minutes need to be completed before 30 June. So that means that you're understanding your tax position and doing the tax planning is very important. Now, tax instalments, again, we touched on this, but when you do finally come up with what your final tax result is, remember that the ATO is quite flexible and they are negotiating payment arrangements. We've got, some clients have negotiated, an instalment for, over a period of 6 months and just put it on hold. So bear that in mind. And it's really important to understand and to make those decisions early on rather than later on. The ATO have also committed that they will not be penalising as well, where you're varying instalments, but then they kind of go the other way. So it's something to keep in mind too. Bad debts as well. Any bad debts that you may have, now is the time. And they need to be written off before 30 June. And remember, to claim a deduction, it must be in existence, it must be bad, and it must be written off prior to 30 June. So they're those elements of that. Donations and prepayments, again, just keep in mind that you can get the deduction and it can reduce your income. And also a superannuation, if you like and need the deduction before 30 June, go for it and do it. But also keep in mind that there is an amnesty at the moment with superannuation, and it actually extends back a few years. So they're basically, what the ATO is saying is that you can't pay your super on time, that you need to let us know and we'll negotiate an extension and we will not penalise you for it. You may be aware that the superannuation is due within 28 days of each quarter, and technically if you don't pay it by that time, you need to lodge a statement with the ATO to say, I haven't paid my super, and then calculate penalties and interest on that. I must admit, a lot of clients aren't aware of that and need to be reminded of that. But this is a perfect time to review and revisit your super and to negotiate and to catch up, I guess, and to make sure that you can get everything sorted out. It's definitely a good time, because I can tell you that paperwork that needs to be lodged and the penalty is time consuming and can be costly. So very important.
Can I just raise a quick point?
Yeah.
So I got pinged a couple of years ago because I wanted to pay my super, and this is just topping up my own super, right? And I assumed that in this day of electronic transitions, that if I, diarised and paid it for, months before, that the money would leave my account on one day, then be in the super fund the next day. And it missed the cutoff. Even though the money had left my bank account, it didn't clear the super fund. So I left 2 or 3 days in advance, and that wasn't enough. So that screwed up my tax planning for the year. So I'd advise anyone who's going to do that to do it at least 7 to 14 days in advance.
Yeah, Jason. And it depends on who you're dealing with, we find, with the ATO in these reviews. Some are more lenient and some are very strict. So, sorry to hear that. But it's definitely something that where we're getting a lot of inquiries around superannuation, plus with the new STP, they're really on top of it. So the compliance perspective, that is very important. So I encourage you to go back, have a look, and make sure that you're up to date. So definitely, yeah. Any other questions?
I was going to say,
Go ahead, Cameron.
Sorry, you go, Jason.
Well, I was just going to ask via you, Tony, and this isn't an accounting question, maybe a recruitment question. Has anyone had any luck in going to clients and saying, well, why don't you prepay for your recruitment in advance, and maybe factoring it in some way? So at least we get some money now, and they're obviously going to get busier next financial year, and they maybe have some incentive to prepay.
I was going to say, I haven't seen any of that sort of stuff really happening at all. But yeah, interested to hear if anyone else has a different experience. Particularly, a lot of government organisations have budgets to spend each financial year, and if they don't spend it, then they lose it. So you do see, I've got quite a few clients at the moment that are ringing me saying, I'm going to be, receiving $1 million between now and 30 June, but it's for work that I'm going to have to do next financial year if I have to pay tax on it. And the answer is you can book it on your balance sheet as income in advance and basically record the income for tax purposes when you actually do the work. But yeah, it's not uncommon for particularly government organisations or big companies to want to spend budgets before 30 June. So it can't hurt to ask the question and see what happens. I was going to say, once you finish your tax planning, it's a really good time of the year to then dovetail that into your budgeting for next year. So once you've gone through your P&L and you've worked out what things you can do, pay some extra super, buy some assets, potentially look at deferring some income to next year if that tax rate thing is something that's of a concern. But now's the time when you're deep into your accounts, start having a look at your budgets for next year, regardless of whether you're in a good or bad position. I think looking at your budgets at this time of year is really important. That you're going to get heaps of value out of doing it.
Yep. Any other questions? Angela, anything you'd like to add? Angela, still there?
Actually, can I add something, Tony, guys? Just in relation to that last question, I agree, Cameron. Specifically in other years, government and large organisations have wanted to spend this year's budget this year, and often I've seen that. I haven't witnessed it anywhere, but what I have seen is for small business, organisations, corporates and government reducing payment terms. So if you've got extended payment terms, particularly coming up to end of year, and if we want to get a cash flow boost this side of June, end of June, I think the conversation for now is, can you pay me at reduced payment terms so I can, have the cash flow faster and not wait till next calendar year or next financial year to do that. That's a slight difference to what I've seen previously around, I've got, 20,000 to spend or 50 or 100,000 to spend, let me pay you now and provide services later. Slight difference just based on current challenges.
That's great. So are you seeing some of your clients pay sooner than they would normally have, based on the government or their announcements saying that that's what they're going to do? Are they actually doing what they're saying they're going to do?
What I'm seeing is agencies receive payments faster. So money being released in much lesser than the standard payment terms.
Okay.
They're not publishing it though. In some areas are, some of the New South Wales departments are clusters, but I think we're in a position these days as small business owners to ask that question. And considering, the conversations around rental and relief and funding there, I think there's a couple of prongs to hit with either with your clients and also with landlords, as you've already mentioned, Cameron.
Okay, great. Has anyone else got any questions?
Just a quick one, guys. Just with the mandatory code of conduct, is that actual law in relation to they are required to actually negotiate, or is it more of just a code of conduct? Because I've had now two conflicting things. I'm sure you guys understand it. One person told me, yep, no, it's mandatory law and they have to follow it, but the other one said, no, it's actually just a suggestion, and that if you want to fight it, you have to go to VCAT.
Yeah, it definitely is a grey and confusing area, but my understanding is it's the former that it is a minimum code of conduct, that if you're in JobKeeper and your turnover's down 50%, your landlord does have to give you that 50% reduction. And if they don't, then you have to go to a tribunal type system to fight it. But I think if you're in JobKeeper and your turnover's down by a certain percentage and your landlord won't come to the party, they're going to look pretty silly when they get to that hearing. Sure. But I do see a lot of landlords bullying a little bit and particularly just pushing back and saying to people, yeah, no, you're not eligible, and no, we can only give you, I've seen some that have come back and said, oh, we'll just give you 3 months rent free, and then, but you need to sign a new 5-year lease, please. And it's like, well, there's nothing in the code of conduct that says that they're allowed to do that. They're just trying it on if they can. So, potentially a tenant could turn around and say, well, no, what you're offering is less than the code of conduct requires, but I'm still happy to accept it for other commercial reasons. But my understanding is no, they have to do it. And the other thing that the landlords are doing is just burying you in requests for information. So they're just asking for, P&Ls for the last 5 years. They're asking for financials, tax returns, bank statements, budgets, cash flows. And a lot of that is bogging people down. But my suggestion
100%.
there is just push back and just say, under JobKeeper, here's my registration form. I'm down 40%, so I want a 40% reduction, please. And I need that now.
I've been definitely doing that. And then the secondary to that was that, let's say we're down 50% on revenue. Does that mean that they get a 50% waiver, or is it a 50% waiver and a 25% waiver and 25% deferral?
So 25% waiver and 25% deferral. So it's half. So if your turnover's down 50%, you'll get a 50% reduction in your rent, but half of that reduction is waiver and half of it is
deferral. Yeah, that makes sense. Awesome.
Which when you think about it, is pretty fair. So it does at least, for some of those businesses that are really struggling, it just means for the moment, they don't have to pay that rent. Some of it they've got to pay back in the future, and some they won't. So the landlords and the tenants are sharing some of that pain.
Yeah, that makes sense.
And just Cameron, we've also had some clients where they get those huge bogged down information requests, and we're actually just providing them a letter with the accountant's sign off saying that their turnover is X this month in comparison, it's reduced by this, and here's the JobKeeper confirmation as well, and they're taking heed on that. I've had a few clients where the lawyers have been put onto the tenant to try and bully them, and we've just given them a copy of the code of conduct, and they've taken that to them and they've backed right off and sort of met somewhere in the middle. And just because there is a 50% waiver, I've also had some tenants who actually don't want to waive it, they just want to delay it and spread it out. So it's really just a negotiation tool, and you can make it work. If you don't want it to be waived, you can sort of agree with the landlord how you want to go forward with it.
Yeah, no, that's excellent. Thanks, Angela. That's great tips.
And just remember as well, where you are the landlord and you hold the property in the super fund as well, there is some guidance around reduction as well, and making sure that you are compliant from a SIS perspective. So speak to your super specialist, make sure that you're doing the right thing there.
Tony, have you got anything else to comment on, or any other questions?
Oh, we're all good with questions. Are we nearly at the end there, Cam?
We are definitely, yeah. We've made sure we've done it in good timing, so that if people have other things to do, they can go and do them.
Well, before anyone goes, and I know people often have to on the hour, this is the golden opportunity. You have got 3 very senior accounting specialists on here and 1 senior bookkeeping specialist in Michael Yarrow. So if anyone has got any burning questions, now is the time. But we will close the formal part of the meeting today. And thank you all very much for being here. If you do have to rush off, and thank you to our sponsors, of course, JobAdder, A Positive, Digit Pro, and William Buck, who have shared a lot of information. And feel free to follow them up in your prospective states to ask further questions. Anyone that does, there's a slide showing their contact details. Anyone that does want to make contact, do so. And they've also very kindly offered a couple of no-charge William Buck hours, which are very consultative sessions to understand your business and then see if they can come up with some initial recommendations for you. But please contact me on that, because they're quite time-consuming and only a few are available. And I can make sure that process works. But look, I think if you can still stay on for some more questions, over to everybody else.